Welcome to the Lend Academy podcast, episode number 73. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I'm delighted to welcome Todd Nelson. He is the Business Development Officer for Lightstream.com. Now, you may not have heard of Lightstream, but they are quietly becoming a major player in the online lending industry. They're actually a division of SunTrust Bank, which is a top 25 bank. And in 2015, they did $1.5 billion in unsecured consumer loans. So they really are already a significant player. And I've been wanting to get someone from Lightstream on the show because I've been very interested in what they're doing. They have, I think, a unique advantage, which is somewhat obvious, the fact that they are part of a bank. I wanted to get Todd on the show just to talk about Lightstream, what makes them different, what sort of borrowers they're targeting, and really how they see the competitive landscape in this industry. It's a fascinating interview. I hope you enjoy the show. Welcome to the podcast, Todd.
Thanks, Peter.
So why don't we get started? Let's just give the listeners a little bit of background about yourself so they can learn more about you.
Sure. So I've been in consumer lending for 25 years, started my career in credit cards back at First USA in Delaware, sort of the heyday of the affinity and co-branded credit card space. And from there, got into other parts of consumer lending, did home improvement, did a little bit of mortgage, ultimately ended up working for a startup auto finance company called People First that was very innovative at the time, and they really changed the way a lot of banks and lenders looked at the direct-to-consumer auto lending space. So their big idea back in the late 90s was to take the collateral out of the lending equation. And so what had always happened historically was that banks would ask a consumer what they were going to buy, and their credit decision was often predicated by what they wanted to buy. So if you wanted to buy, say, a Ford F-150, well, they would think about that as a different credit decision for the same consumer as someone that wanted to buy a BMW 3 Series. So it was very much collateral based. And so People First's big idea was, we're just going to underwrite the consumer, and if they're good for the money, then we'll let them buy whatever vehicle they want. So that was a big leap forward in auto lending. So that business grew, was eventually acquired by Capital One, and we became part of Capital One Auto Finance. And the founders of that company left, and I stayed on as part of Capital One for several years. Then ended up getting into the marketplace lending space very early with a couple of different companies, one of whom did not survive. The other one is Lending Club, and was there for a few years. And then got back into auto finance in the subprime space, working at car finance, rejoined with those same entrepreneurs in their second startup, which was called First Again, which does online unsecured consumer lending. That company made loans for about 3 years, stopped making loans during the recession, and was eventually acquired by SunTrust Bank. And so now SunTrust bought it about 5 years ago, relaunched it 3.5 years ago as Lightstream, and I rejoined them again as part of Lightstream about 4 years ago. So now I've been kind of back with those same entrepreneurs now for my third tour of duty for about 4 years.
Right. Okay. So but it sounds like you've really spent your career in the lending business. So just curious, what did you do at Lending Club?
Business development. So I was there, I was almost 5 or 6 years ago now. So we were pretty small. We were still down in Redwood City and had, 40 or 50 employees at the time. So just working on growing the borrower side of that business through partnership.
Okay. So Lightstream came about after it was like rebranded. First Again, got going, and then SunTrust Bank bought it and rebranded it to Lightstream. And I guess I'm curious. Like, it sounds like there was like this gap. I mean, and I'm curious about what was SunTrust's plan? Well, like, why did they buy a company that was clearly not, you said you stopped lending and the financial crisis happened, and, what was, do you know the thought process behind what SunTrust was doing?
Yep. So SunTrust, like lots of banks, fairly active and interested in acquiring consumer debt assets. And so their initial conversations, I think, with the founders of First Again were to buy the portfolio. So we had put a couple $100 million of unsecured consumer loans on the books during 2007, 8, 9. And that portfolio was still sort of paying off, and SunTrust came along initially looking to purchase the portfolio.
Okay.
And what they realized during those conversations was that the portfolio was performing very well, even through the recession, despite the fact that it was unsecured. The real value was the company itself and the technology and process that they had built. And, SunTrust is a great, very stable, fairly conservative Southern bank. And, not one that's generally been kind of the leader in terms of sort of technology and those kinds of investments. And they realized that the technology that First Again had developed would allow them to go from, kind of middle of the pack to the very forefront of consumer lending in one acquisition. And they could do so faster, cheaper, and better than they could probably have built it internally. And so they purchased the whole company and brought those entrepreneurs along with them. And so that was a big leap of faith for them, because it was something that was really sort of outside of what SunTrust typically does. And it's paid off very well. So, we've grown significantly since we've relaunched. I think now, actually, according to data that you provided, we were in the top 5 last year in terms of consumer loan originations, kind of in this unsecured space, and we continue to grow. So it's been a great acquisition for them, and it's been very positive, I think, for the millions of consumers we've touched.
Mm-hmm. Okay, so let's just talk a little bit about your offering. I mean, what kinds of borrowers are you focused on? Whereabouts in the credit spectrum do you play?
So being part of a bank, our appetite for risk is somewhat limited. So we're really focusing on prime and super prime borrowers. So if you want to think about the entire credit spectrum, we'll probably target the top third, if you will. That's kind of our focus.
Okay, so do you have a FICO cutoff, or do you what would be your average FICO score of your loan book?
We do. We think about FICO maybe a little differently than some other lenders do. I think lots of smaller lenders and some of the marketplace lenders are very fixated around FICO as being kind of the end-all, be-all for credit and performance, and we don't think about it that way. For us, FICO is more of a disqualifier. So if someone applies today and has a FICO score under 670, we're going to automatically decline them, and an underwriter's not going to look at that application. It just falls out automatically.
Right.
If they're above 670, then it will go into the underwriting queue, and ultimately the FICO score itself is really a non-factor. What we care about is underwriting that individual on a more holistic basis. So because it's unsecured, we're really just underwriting the individual, and that means we're going to look at the depth and breadth of their credit history, look at how they've used credit in the past, and then look at things like income and assets, right? So that gets to their ability to repay us. And, we're not going to make a loan to a consumer that's going to be a stretch for them and put them in sort of financial peril. That's not who we are. But for those folks that, have good credit, they have stable income and have some assets, we think we've ended up, offering them really the best-in-class solution in terms of just speed, transparency, and ease of use. And obviously, we offer very attractive interest rates.
Mm-hmm. Mm-hmm. Sure, we'll get to that in a little bit. Yeah, so I guess just one thing as an aside here, I think you'll find that many of the online platforms actually operate in a very similar way. They use FICO as really a hard cutoff for people who, say, if you have less than 660, less than 640, whatever it may be, the different platforms have different criteria. But then they'll typically go into, an underwriting process similar to what you described. Now, not everyone's like that. Some people really are very focused on FICO, but I think you'd find that most of the online lenders now are using it just as one of many data points. But anyway, I want to move on to the terms of the loans. So can you give us some idea about the amount, the length, the different loan term lengths that you offer, and the rates that you offer?
Mm-hmm. So we offer loan amounts from $5,000 to $100,000, again, all unsecured. And we'll do terms ranging from 2 years to 7 years, so 24 to 84 months. And we allow the consumer to pick both their loan amount and their term. So if they want 73 months, they can have that. If they want 81 months, they can have that. If they want 27 months, they can have that. So we allow them to pick their own loan amount and term. And then we price based on 3 things. So loan amount, term, and loan purpose. And so I think where we differ than many of the other folks in this category is that we think about loan purpose and it factors into how we price. And so part of it's based around sort of risk and experience there, and part of it's based around the competitive set. So for instance, if you look at our interest rates today for, say, new or used automobile purchase, I think up to 60 months, our rates start at 1.74. Right? Incredibly low, very, very competitive rates. And that really is, for the prime and super prime borrower, if you don't have an interest rate, starting with a 1 or a 2, you're just simply not competitive, because that's how, banks and credit unions and the captive finance units at the dealership are able to price. So right. In order to play in that space, you need to be able to price aggressively. If you look at a different category, like say, debt consolidation, I think our rates start at 5.49% APR today. And again, priced very competitively. Generally speaking, we are the low cost provider in the market. Part of that's being the benefit of a bank. And really for us, we're wanting to communicate that message to the consumer that, if we can approve you, you are not going to get a better rate from someone else or a better customer experience. And we even have a rate beat guarantee. So if a consumer can actually get approved by another lender for the same terms and amount at a lower rate, we'll actually beat that rate.
Okay. So that is interesting. That is very different. And also, those rates are a lot lower than just about every other online lender. So I'm curious, I'm on your website right now, and you see, you've got auto, you've got, motorcycle, you've got debt consolidation, medical, etc. Where does it, Lending Club, Prosperity, as I'm sure you're aware, it's, debt consolidation is really the biggest category. What is the biggest category with you guys?
So for us, we've got several categories that are bigger than debt consol. And I think that's one of the opportunities in this space. I think that the marketplace lenders have been really successful kind of using the same playbook that we had 20 years ago in credit cards around balance transfer. Right? You go to the credit bureaus and you run a pre-screen and you find people that have existing balances, and you offer them the ability to refinance it. So the card companies always did it as a balance transfer, and I think Capital One was really the originator of that 25 years ago. Mm-hmm. And then the marketplace lenders sort of picked up that same playbook and said, we can do the same thing here for debt consolidation. So if you're paying 20% on your credit card, we can get you an unsecured loan at 12% with some kind of fee. So it's a better deal for the consumer. I think the interesting part is I think the broader set of players in the space, the personal financial software websites and things like that, oftentimes categorize this unsecured loan category really as being synonymous with debt consolidation. Mm-hmm. But for Lightstream, our business is much broader than that. We really tend to market more to consumer need. And not that debt consolidation isn't a consumer need, it's just not nearly as big as some of the other needs that are out there. So, the auto finance business is a $1 trillion market, right? There are 50 million cars sold in the U.S., new, used, private party every year. So lots of transactions there. And so that's a big part of what we do. In fact, that's our biggest category, is auto. We're also very big in home improvement, right? There's a big need there for consumers that want to do home improvement projects. And I think, if you go back 10 years ago, a lot of folks used home equity for that.
Right.
And, part of those decisions, which some of them weren't all well chosen by either the consumer or the bank, didn't end well, obviously through the recession. And, but home equity as a category has really shrunk significantly from where it was 10 years ago. Today, if you're a consumer and you want to do some kind of, home improvement project and you have equity in your home, and not everyone does, it's a much longer, more arduous process today to get a home equity loan. You're looking at, 2 months most of the time. and fairly paper intensive because of all the requirements now that banks have around that product. So we offer a really nice, much simpler alternative, again, at very competitive interest rates. I think in home improvement, our rates start at 4.29. So very competitive with home improvement. And again, it's unsecured, so you can do, whatever kind of project that you want to tackle with that loan.
Right. So I just want to go back to that. So these are unsecured loans. You say auto is really your biggest category. So how does it work? We've got auto finance is obviously a huge industry, as you mentioned. And you're not tied in with dealers, I presume. And how does it work? You don't have security in the car. So just explain how it works.
So our auto business at Lightstream is strictly direct to consumer. Now, SunTrust does have a dealer financial service group that does indirect financing. So the financing that you can get when you show up at the dealer and you apply with the finance manager, SunTrust does play in that business. It's just a different line of business and not what we do. And so that's referred to as obviously the indirect side of auto lending, and Lightstream is really the direct to consumer piece. Indirect is significantly larger, by the way, from an industry standpoint. I think the numbers are something like 80% of the people that finance a vehicle purchase do so through the financing provided at the dealership. Mm-hmm. And that includes, banks and credit unions, as well as the captive finance units like Ford Motor Credit and so forth. So, the value of being direct to consumer, and I think this works for all consumers, is that you can apply for financing up front. You know exactly what your interest rate going in is, which then puts you at a little bit more of an advantage, A, in negotiating the price of the vehicle, but B, it also shines a lot of light on what's otherwise a very opaque process at the dealership. You get a rate from the F&I manager, but you don't always know, is that the best rate I could have gotten? You really don't know what's going on there because you just don't have the information. There's a real imbalance of information from the car buyer versus the F&I manager. So this is an opportunity to kind of shine a little light on that for the consumer. So for us, it being unsecured works well because it allows us to lend to the consumer, and they can buy any vehicle from any seller anywhere, right? So it's not just limited to, vehicles in a dealership. You can buy, your neighbor's car. You could buy a vehicle off, eBay or Craigslist. You could buy something overseas and have it shipped to you. So because it's not collateral specific, the consumer has the flexibility to buy whatever they want, which is just a fundamentally different way to think about auto lending. So again, right. I think that we've done a little bit more pioneering in that auto loan category by taking the collateral, not only out of the underwriting decision, but really out of the whole process.
It's interesting because really you're doing unsecured lending, so it doesn't matter really whether they're buying an automobile or a home improvement loan. And it's interesting that your rates are so different depending on particularly the low end. They're quite different depending on what the purpose is. So, clearly a borrower could look at your website, and I don't know how much, you can tell me how much this happens. A borrower looks at your website and says, I see that, auto is the cheapest, and I want to do, whatever, I'll have a medical expense, whatever it is. And so they say, take out an auto loan and get the cheapest rate. But in reality, they're using it for something else. What's your reaction to that kind of thing? Does this not happen very much?
So the consumer is obligated, part of our terms and conditions in the note and security agreement, to use the funds as agreed. So if they say they're going to get a car loan, they're obligated to do so. And if they don't, we have the ability to call the loan or to reprice them. The one thing about sort of super prime credit is they tend to be a little bit more transparent. And, I would guess as big as we are, we probably have had customers that have cheated there. We hope it's fairly small, but something that we certainly, don't want to have happen often. And, our underwriters do a fairly good job of vetting our borrowers and, making sure that what they say they're going to do lines up with their lives. So we pay very close attention to that.
Right. Yeah, just a little bit on the underwriting process. Are you using 100% manual process? How does it work?
It is. So the decisions today, the approval decisions are all made by a human. So like I said, we've got a model where if they don't have the minimum FICO score on the way in, then we'll just automatically decline them. If they're, above that threshold, then it will go to a human, and an underwriter is actually going to look at it. Oftentimes, they will have a conversation with the borrower, where they'll send them an email and ask them to call in, and they'll have a conversation about the transaction. And that allows us to do some vetting, really understand sort of that kind of broader financial picture, and ultimately make a decision. We still render decisions very quickly, oftentimes inside of an hour. But the real beauty is once a consumer has been approved, they're done. They are able to essentially self-fund. So if you get approved, you're going to get an email from us that says, Peter, congratulations, you're approved. Please log into the website, electronically sign your loan documents. So you go into the website, you e-sign your note and security agreement. At that point, you would put in your bank's routing number and your account number and tell us the day that you want the money to go into your account, which can be the same day or up to 30 days out. So let's just say that you applied for a loan this morning because you're going to go buy a car tonight. You could fund your account this afternoon. We'll either ACH or wire the money directly into your checking account, and now you've got the cash to go buy your car this weekend. But if you maybe weren't going to do it till next weekend, you say, what, put it in my account next Friday. So it's very powerful for the consumer because they can control when they fund, and they get 100% of the loan proceeds on the day they select without any discounts or fees. So we don't charge any fees to our borrowers. So if you borrow $50,000 at 1.74 and you want it next Friday you're going to have $50,000 from SunTrust in your checking account at 1.74% interest. Mm-hmm. At the same time, when you're in there funding your loan, the consumer will decide when they want to make their monthly payment, so they can select any day of the month they like, and then we'll auto debit from their account on the day they select.
Okay. So that sounds good. So how do you find these borrowers? What's your main source? Are you getting these from the bank? Are you getting these 100% online? What do you do?
So we are the only way one can apply with Lightstream is online. We don't take applications over the phone. You have to come in through the website. It's most efficient for us, allows us to offer very low rates because we try to minimize our own overhead. We source business from a number of different places. So one is obviously SunTrust. So we cross-sell to the SunTrust customer base, and that's a big piece of our business. We also have a number of partnerships and affiliates who refer their customers to us. So that's a big chunk of our business. We do a fair bit of SEM. So if you're on Google or Bing and searching for different types of loans, you can find us that way. We also have started doing direct marketing, including mail. So leveraging, again, that same playbook, finding those borrowers and making them offers via mail. And then there's a fair bit of kind of repeat and referral business. We do things in social media and other things that are a little harder to track. So that's the kind of the balance of our business. Okay.
So then are you available to borrowers in all 50 states, or do you have...
We are.
Okay.
Yep.
That's cool. So I just want to switch and talk about the funding side. Obviously, you're not a marketplace. You don't have investors per se. And so do you hold, are these loans held on the Lightstream / SunTrust balance sheet? Are you securitizing these? What is your funding sources?
So the source of, we're a bank, right? Yeah. So we're part of SunTrust. So our funding sources are our deposits from the banking side of our business. So all the loans are SunTrust loans. We hold everything today. I don't know if the bank has done a securitization recently. I think, we still have an appetite for assets. So as far as I know, we're holding everything, and we service all the loans that we originate. So everything stays in-house.
Right. Okay. So who do you see then as your main competitors? Because, I look at this and there's some crossover with a Lending Club or a SoFi or a Prosper. But who do you see as your main competitor?
Certainly those marketplace lenders are competitors to some extent. I think the reality is if we want the same customer as one of those guys and we both make an offer, generally speaking, our rate is always going to be lower. We're not going to charge them a fee, and we've got a far more efficient, transparent process than they do. So, I don't mind them as competition because, frankly, I feel like we win head-to-head every time. Now, the difference is that they will go further down the credit spectrum than we will. So there's that advantage that they have. in serving what we would refer to as non-prime borrowers. The other sort of competitors, I mean, really, it depends on the category that we lend in. And I think this is where we're really different than the marketplace lenders. For us, this category isn't really exclusively about debt consolidation. It's about, trying to serve consumer needs kind of much more broadly. We don't think about this as sort of just unsecured generic loan. For us, it's really more about what's the customer want to do. If they want to buy a car, then we've got a product for that, which is interesting because if you think about how banks have always historically lent, it's always been collateral specific, right? If you want to buy a house, you go to your bank and you say, I want to buy a house, and they say, okay, we've got a mortgage. And if you say, well, I want to buy a car, they say, okay, we've got a car loan. And then you say, well, I want to buy a motorcycle, and they may or may not have a motorcycle loan, right? It just depends on whether or not they've decided to play in that collateral category. For us, because it's unsecured, we can play in just about every category. So we really think about the customer need, because if I go to a customer and say, hey, Peter, do you want to consolidate your debt? You say, I don't have any debt. I think, well, what else can we help you with? Well, I'd like to buy a horse. All right, we can help you with that. So for us, it's really trying to find that consumer need, and it's not limited to debt consolidation. So we tend to, market around those needs, which, for many other lenders historically have always been very collateral driven. But for us, it's just about customer need. What do you want to do? And then the overarching value prop is for those consumers that have, good to excellent credit, they deserve a loan process like this. Like they deserve the ability to borrow money without a lot of hassle at very competitive interest rates in a really easy process, right? And so the limitation of our business is that we're not going to approve everybody, right? We're pretty comfortable with the credit risk that we take, but that means we don't approve everybody. But for the ones that we will, we guarantee it's the best loan experience they'll ever have. In fact, we've got a $100 loan experience guarantee that's part of the process. So if a consumer funds a loan with Lightstream and they're not happy with anything that we do, we'll pay them $100 to fill out a survey and tell us about it.
Okay. Interesting. Very interesting. So, you guys are a part of a bank, and it's curious to me that banks, that there's not, 50 different banks that have a similar offering to what you guys have. I mean, and Lightstream has been around for a while. And are you surprised that other banks haven't really decided to do exactly what you're doing? And also like to get your perspective on why you think other banks haven't done what you've done.
I think it's hard. I think I give our ops team and our credit team a lot of credit for what they do, because they make something that's really, really hard look really, really easy. And I think that that's the biggest reason. If this were easy and it were simple, then to your point, every bank would be doing it. But it's not. And I think for banks too, SunTrust made a really kind of big leap of faith, kind of moving into this category. But I think they understood that, with the company that they acquired, they got a lot of knowledge and insight into consumer lending. And it enabled them to buy a piece of technology to bring them, very quickly to a leading position in a category where, if you're a bank and you're wanting to do that, it's really expensive to build out technology. It's very hard to leverage your existing technology because most banks' technology, frankly, is probably old and not terribly flexible.
Right.
And so you've got to be willing to either blow up what you have or invest very, very heavily in building something that's completely different. And that's really hard for a big financial institution to do.
Right. Yeah, makes sense. So then, speaking of that, so do you find that, or how much is SunTrust involved in your business? I mean, are you getting strategic direction from them, or are you really like an independent subsidiary that doesn't have a whole lot of oversight? I mean, what's the relationship like?
We're a line of business within the bank. So, we report up into our consumer lending and private wealth group. We're, the bank sort of looks at us like some of its other lines of business. So, we have a mortgage line of business. We have our dealer financial services business. We have a HELOC business. We have a credit card business. We have a student loan business. So Lightstream is just another line of business within the bank. So our partners kind of internally, whether they're, legal or finance or compliance, are all from the same sort of shared functions within the bank. So we're kind of standalone from a business standpoint, but everything we do is still very much part of SunTrust. So
Okay.
while we're, kind of innovative from a technology and sort of service delivery standpoint, we're still part of SunTrust, right? All of our loans are SunTrust and everything's done kind of under the guise of making SunTrust loans.
Right. Yep, that makes sense. So I got to let you go, but before I do, I mean, what does the future look like for you guys? I mean, do you want to be, the biggest online consumer lender? I mean, right now, as I said, you sort of with the numbers you shared with me, I pegged you about number 5 in 2015 at $1.5 billion in loans. I mean, Lending Club is, even despite their challenges, are doing a lot more than that. What are your goals here?
We're going to grow. I mean, I would tell you that I'm a pretty competitive guy, and I like to look at what the other folks in that category are doing, and we've set our sights far above where they're at. So they've had a nice head start in some cases, and they've got interesting business models. But we feel pretty good about what we've got. We feel really good about the value proposition for the consumer. And at the end of the day, I think there's room in the market for lots of those companies to be successful. And, we think that the niche and the process that we've developed will serve us well to grow, well beyond where we are today, and ideally to be on that the top of that leaderboard, if you will.
Okay, well, on that note, we'll have to let you go. I really appreciate your time today, Todd.
My pleasure, Peter. Thank you.
Thank you. Bye.
Bye.
A company like Lightstream has an obvious advantage, and that is their cost of capital is so low that no non-bank lender, whether you're a marketplace or balance sheet lender, can really match that low cost of capital. So they have an advantage on price, and that's clear when you go to the Lightstream website. You see that their rates start at less than 2%. So I expect them to continue to do very well in this space. But, price is obviously an important factor when it comes to consumer lending, and it's not the only factor. And, Lightstream feel like they have an advantage in all kinds of different areas. So it'll be fascinating to see what plays out over the coming years. We've got Goldman Sachs coming in soon, and no doubt there will be other banks that will be taking on the space. So interesting times indeed. On that note, I will sign off. I very much appreciate you listening, and I will catch you next time. Bye.